All right, we should be officially good to go. Hey there, everybody. Good afternoon, good morning, good evening, depending on where you're at in this beautiful planet. I hope you guys have had a good trading day so far for those of you trading futures, right? For those of you who do not know me, my name is Allison Ostrander, and I am the Director of Risk Tolerance here at Simpler Trading. And I wanted to do this session here because last year I noticed a signal that started to set up on the quarterly chart. Some of you may have joined me for that aftermarket webinar last year to kind of talk about the setup, and we are waiting into the close of last year to see whether or not the bar would actually print the valid signal. It did. And so now I'm jumping back on the mic before we go into next quarter to re-talk about this signal for some of you guys who may have missed it, as well as potential targets for where the market could move next quarter. Hey, Ari, good to see you. Long time no talk. Absolutely. Hey, Chad, SB, great to see y'all. Mirza, thanks for that too. Appreciate that. So let's go ahead and get going here. Let me just do one thing really quick. There we go. Now I can see all the chats. Perfect. So for those of you who don't know this setup, this is actually something that I started to do some longer term analysis on last year. I noticed going into the end of last year that we were going to make what is known as a bearish divergent bar. You can see that with this pink bar that printed here. For those of you unfamiliar with the divergent bar indicator, it basically helps clue you in to a high probability of potentially getting a higher high or lower low compared to the bar that prints the divergent bar. So a bearish divergent bar looks for a lower low, and a bullish divergent bar like this one back here looks for a higher high. And I usually give this 3 bars to work out. So as you can see, we made a bearish divergent bar last year. That's a good possibility that within the next 3 years, we could see a move back down to or below 34.91 and 58 cents, which was the low of last year, right? Good chance. But I was kind of curious, right, how this was going to work out. For example, we made a bearish divergent bar in 2018, and the low of that was 23.46.58. Didn't follow through within the next bar, but 2 bars later, that's when the COVID lows happen, right? Funny how that works, where the technicals clue us into a possibility, and then the catalyst is something rather unexpected, but the technicals still allowed us to get an early warning. And so in the case of the COVID lows, that was down to 2191.86. That clearly was lower than the 2346 low. And so it followed through with its lower low within the second bar. But if you go back further in time, you'll notice that in 2007, we printed a bearish divergent bar before that bigger downturn in 2008. And we also had a bearish divergent bar that printed in the early 2000s before the bigger turn down that happened here. And so last year, whenever I was looking at this bar, likely going to set up and print, I was curious to see if there is a way that I could try and identify whether or not it would be a situation like we had in 2018, right? Where it might take a couple years, where it barely follows through with a lower low, or if I could identify a situation like we had in 2007 and in 2000, where we had the immediate turn down the next year with a stronger follow through and stair step to the downside. And so that had me going into my quarterly charts. And I did start to notice a setup here where if we got a bearish divergent bar on the yearly chart, on the quarterly chart, the clue that there could be a bigger downturn came about with the underlying price trading below the 10 period simple, as well as a valid bearish pullback signal on the compound breakout tool. So for example, let's just zoom in here to 2008. In 2008, basically the way this signal has set it up and has worked in the past is we want the underlying price to close below its 10 period simple. So the bar needs to stay below the 10, and we need a valid signal on the compound breakout tool. If we can get that for 2 quarters in a row like we did here, then not the next quarter, but 2 quarters after the signal prints, usually ends up being a pretty strong down move for the market and usually has the biggest quarterly range for whatever is going to happen until we hit the lows or the bottom of the move. So you can see in 2008, we had 2 quarters where the bar printed below the 10-period simple. They remained a valid bearish signal on the compound breakout tool. The next quarter saw further selling, but the biggest quarterly range happened on that second quarter after the signal printed. Back here in 2000, we just barely closed below the 10-period simple for the quarter, but we did, right? Also a valid bearish signal on the compound breakout tool. The following quarter remained the same. So we got the 2 quarters to print below the 10-period simple with a valid pullback signal here. The next quarter actually kind of happened like what we saw for the first quarter of this year, where we actually bounced up a little bit. But the following quarter, the second quarter after the signal printed, was the biggest quarterly range that we had to the downside before we hit the bottom. So this quarterly range was $295.03. And if you look at all the other remaining ranges that we had until we hit the bottoms, that one was the largest range that we had to the downside before the lows. Now, of course, this move lower happened a bit more gradually, but it still happened. Let's go back to 2018 now. In 2018, right, this is where we had the bearish divergent bar print, but did we ever get the quarterly setup? And the answer is no. We had our first quarter at the very end of the year closed below the 10, and we attempted to start to print a bearish signal, but the next quarter immediately canceled that out. And so that to me was my clue of, okay, well, maybe, right, this could be a similar situation to what we have this year, right? That could be the clue on whether or not we're going to see a bigger follow through this year on a potential lower low, or if it's going to be more of a quote unquote non event like it was in 2018 into 2020. And as you can see here, going into the end of this year, we started to see the signal print last year at the third quarter of last year. And then this is what we are waiting on to see whether or not we would remain below the 10-period simple moving average at the end of the year. And if we could get the bearish signal to remain valid on the compound breakout tool, and both did, right? So we closed below the 10-period simple. The compound breakout tool remained valid. And so that's a clue to me that we might continue to see a stronger move to the downside next year. Now, very much like in 2000, we actually got a bullish divergent bar here for the last quarter of the year. Notice that it has followed through with the higher high. And currently, for this current quarter that we're in, depending on how we close it at the end of the week, we have the possibility of making a bearish divergent bar, which I personally like, right? That only adds a little bit more fuel to the fire that we could see a stronger downturn next year. Now, this quarterly signal doesn't print very often with the yearly bearish divergent bar. As you can see back here on a yearly chart, it's not like we get yearly bearish divergent bars very often. But the signal has printed 2 more times, and that was back in the 70s. So just let me show you the examples back here. So back in 1969 going into 1970, we had 2 closes below the 10-period simple. We had the valid bearish signal on the compound breakout tool. The next quarter kind of remained flat, but that second quarter after the valid print had the biggest downturn and actually indicated the bottom of the move. Then we have here in 74, where we started to print below the 10-period simple, right? That was a pretty strong close below the 10. It followed through with a move lower here, valid signal on the compound breakout tool. And then the second quarter saw a continuation on that move lower, but the biggest quarterly range to the downside happened here off that second quarter off the print before we finally hit the bottoms. And I do apologize if you guys hear the kids in the background. Wasn't planning on them going off. The market's not open for the baby indicators, but bear with me, guys. So as you can see, right, pretty consistently, every time the signal has printed in the past in line with bearish divergent bars, we have seen that strong, Thanks, Ari. I appreciate that. We have seen stronger follow throughs on that second quarter to the downside. Kelvin, yeah, baby indicators work for futures too, right? So, what does that tell us about this possibility? Well, that we might get a bigger move to the downside. But now that we've, identified that the signal did print at the end of last year and that we're about to go into the second quarter after the signal's printed, let's dive into the actual numbers now on how this has worked out in the past. So, from those moves in 1970, as well as the moves that happened in the early 2000s when we've had these bigger downturns in the market, we have usually seen anywhere between a 25 to 48% move lower from where the signal has printed to whatever the bottom of the move is, right? To whatever the low is before the move back to the upside. So 25 to 48% is what we've seen towards the bottom. But what's interesting is that specifically in that second quarter drop, right? Because the second quarter doesn't always signal that that's the bottom of the range. Oftentimes it's not, right? It only happened one time where the second quarter also aligned with the bottom of the move itself. Otherwise, though, usually there's still a little ways to go. But the second quarter that prints after the signal usually encompasses anywhere between 69.47 to 94% of that remaining move lower, right? So a good chunk of whatever is left on the move lower, a good chunk of that happens within the second quarter. So what I've done is I've gone through the numbers based off the close of last year for where we could potentially end up finding the bottom of this move if it correlates in the same way, as well as where we might see the bottom specifically happen for next quarter. And for those of you that are in the simpler trading rooms, either the options or the free rooms, I do have snapshots of my trading journal here with all these notes, and I will be more than happy to add them into the room drives afterwards. So that way you guys have access to these numbers and you can see all the math that I've done. But let's just talk about some of these ranges. So if we're on the more conservative side of things, and let's say it's a 25% drop to the downside, then that means from the close of last year, which is 38.39.50, that's where we closed the year. A 25% move lower off of that number is a 959 point drop, basically 959.87, which means that we could end up seeing a move down eventually to 28.79.63, right? So that is a pretty big drop to the downside. But we don't know if that's going to happen rather quickly, like it did in the 70s or like it did in 2008 after that signal print, or if it's going to be more gradual, like it did in 2000, right? Not sure of that catalyst. The most aggressive target to the downside would be like what we saw in 2008, where we have over a 47% move drop. Unless there's an outside catalyst that I'm not aware of, kind of like what happened with COVID, right? Which could very well be the catalyst for what our technicals are hinting at. So who knows? But I only did the math up to a 45% drop. So I'll make that point. If it moves like 47.2 or whatever, then it might be a bit more to it. But for a 45% drop based off the close of last year, if that happens, we could be seeing about a 1,727 point drop to the downside in SPX. Now that's pretty aggressive, but a possibility. Now, before I dive closer into the numbers for next quarter specifically, because those have a much better track record on how they can work out, I do want to point out that all we can do as traders is put our capital risk out there and control it. That is the only thing that we personally can control in the market. We're not Warren Buffett, right? At least I don't think Warren Buffett's out there listening right now. If he is, hey, but we don't have Warren Buffett size accounts to really manipulate the market, right? That's not who we are. And so all we can do is go best off of what our technicals tell us and control the capital risk that we put out there. That's it. And so this could end up being a case where this is the very first time that this signal is printed and it doesn't follow through, right? That's a possibility. So I want to make sure to make this note out there before you guys load up your account to the bear side. At the end, after I talk about the numbers, I'll walk through a few different trade ideas that I am looking at on how I can manage my risk and keep it very small, but still allow myself some excellent profit potentials. So that way, if we do end up following through with this move, and it does work out the same way it has in the past, that we don't blow out our account if it doesn't work, but at the same time, we can make some excellent profits if it does work out. So I just wanted to make that little footnote before we continue. But let's now talk about specifically for what we can maybe anticipate next quarter. The first thing that we can anticipate is just off the current bearish divergent bar, right? If we get an immediate follow through with a lower low, then that means we could be looking to go past what the low of this year has been, which is 37.94.33, right? So that could easily be a first target to the downside. If we go off based off the math, though, from what we've seen in the past, then the most conservative target to the downside would be based off of an overall 25% drop in the market and to have it in line with a 65% move down. Because if you recall, what I mentioned prior to this was the ranges, right, that happen for that remaining point drop are usually anywhere between 69.47 all the way up to, the high 90s for that remaining range being to the downside, if that makes sense. So what I mean by that is the second quarter after the signal prints usually encompasses the biggest quarterly range. Doesn't mean we'll necessarily close at the bottom of the range, but the biggest quarterly range that encompasses the majority of what's remaining to the downside is 69.47 to 94% of whatever that overall bigger move is lower to the bottom of the move itself. So if we go off the most conservative point drop from what we've seen in the past, and we go off the most conservative range that we have typically seen on the 65% side, that means that we're looking at a move down to $3,215.59 in the SPX. Now, after I did this math, what is very interesting to me is notice where support is on my quarterly chart right now. The ATR trailing stop is at 32.1984. Funny how that works out, right? How that first conservative target to the downside for next quarter would bring us right by the ATR trailing stop as support and right by the 30 period simple as support, which is at 310709. And I begin the drop measurement, TNT, great question. I begin it just like I have on all the prior years when I've done this math out. I do it off of where the signal prints. So the signal printed for us at the close of last year. So the close of last year was 38.39.50. So that is where this math starts and where we go from. Great question, though. And yeah, Jerry, of course. See you over there on YouTube. So that's the most conservative target is 32.15.59. The most aggressive target, which like I said, I'm not planning for it to get this bad, but if we do really continue to drop, right, it's good to know where these numbers are. The most aggressive target would be if we saw a 45+% drop in the market like we did in 2008 from where the signal prints, and we get the majority of that bearish move to happen within the next quarter. Now, once again, I don't know what kind of catalyst would be out there to cause that situation to happen, but if it happens, that move would bring us down to 2198.12 in the market, which would actually be right by the COVID lows, which is where I know some of the bigger players like I think the big short guy on Twitter, he mentioned last year he was looking for potential retests of COVID lows and things like that. So once again, it's just kind of funny how those levels play out with the math. but not necessarily anticipating that for myself, right? That's a pretty big drop. So that's roughly the big range to the downside. Now, of course, when I've done this math, I've broken it down in a way where on a 25% drop, I look at anywhere between 65 to 95% of the move living within the next quarter. Off a 30% drop, in the market in total, which would bring us down to 2687. I do the math once again of what a 65% to 95% move would look like within the next quarter. And so there are some numbers that continue to correlate throughout these drops that I'll mention. Starting, of course, with that 3215 level. And then another big level that continues to pop out throughout these equations is right around 3000. That's another big level to consider to the downside. Another one that continues to pop up is around the 2950-ish range, really 2970 to 2920. That one pops up quite a bit, as well as 28,000 and then 27 and 26,000. And then from there, like I said, we would really need to see some pretty big drops to the downside. So 27,000 is my more aggressive target personally to the downside. After that, it would, be a pretty strong move if it happens for a move lower overall for next quarter itself. So, right, those are some of the bigger targets to the downside. And like I said, I will be more than happy to share these with y'all in the room drives over at Simpler. My handwritten notes that I have set up here so you guys can take a look at exactly the percent move down and everything like that and what that kind of looks like as a point move, as well as what number that correlates with for SPX itself. And then from there, I did a little bit more on the math side. So before I do that, though, let me talk about some of the levels where these numbers line up with. Now, I talked about how the most conservative target of 3215 lines up pretty well with the ATR trailing stop and the 30 period simple moving average on the quarterly chart, right? So that's levels to be mindful of. One of those other big levels that pops up in the math is also in line with the 10 period simple on the yearly chart. That's at 3108 currently. So that's another big level to consider to the downside. And then the last technical level that I have that really lines up with these numbers is the monthly 100 period simple, and that's at 3000. So those personally are my more bigger targets that I think have a better likelihood of hitting if the follow through on the quarter actually happens. Now, once again, it may not work out, right? This could be the first quarter where this signal is printed and doesn't follow through in the same way that it has in the past. But there's some good news for us. The good news is when we go back in time and look at how these quarterly bars have set up, you'll notice that the majority of the time on these second quarterly bars where they have the biggest range, almost all of them open right by their high, right? Actually, all of them do. So, for example, on this 2008 bar, we opened the quarter at 1164.17. The high of the quarter was 1167.03, only 3 points higher, right? Before it overall started to move lower. Back here in 2001, the open of this quarter was 1224.42. The high of the quarter was 1239.78. So roughly a 15-point move higher from the open to the highs before everything really started to drop off. Back in the 70s, let's go back in time some more and put on our bell bottoms. Here, we opened the quarter at 89.63. The high of the quarter was 90.70. So a little over $1 move higher than the open before it dropped. And then back here in 74, we opened the quarter at 86. The high of the quarter was 86.89. So less than $1 move higher before it dropped off. So the good news for us is if this signal follows through the same way that it has in the past, then wherever we open the quarter, we shouldn't anticipate a strong bounce to the upside, right? We might move a little bit higher, but I wouldn't anticipate a strong break, let's say back up into 4,200 or anything like that. Of course, depending on where we close. If we close the quarter for whatever reason at 4,190, then yeah, 4,200 would make sense. But if we're closing the quarter where we're at here, right, and then all of a sudden at the start of next month, we really start to rip higher, that could be a clue to us that this signal may not follow through the same way. And we could already look to close out of maybe some of these bearish trades that we put on to protect our capital risk. So that's the good news for us, is that we should know rather early in the quarter whether or not this may work out the same way it has in the past or not. I did dive in a little bit more in detail. Let me go to the monthly chart now. So I did dive into the monthly time frame, Sun, just like I did from the yearly to the quarterly chart, to try and see if there was a specific month where we really started to see the selling take off, right? To where we could maybe time an expiration to do this overall. And so unfortunately, though, it doesn't quite work out as cleanly as the quarterly signal does. And what I mean by that is there's not really one month out of all the years that this signal is printed that encompasses, right, where the start of the selling is or where the bigger range is. And so let's go back here to 2008, for example. So this is the start of the quarter, and you can see in October, the start of the quarter, that was really the start of the selling, right? That encompassed most of the range. We had a pretty big range the second month of the quarter, and then the third month of the quarter is where everything started to stall out. So the first 2 months were really where that big move to the downside was encompassed on that quarterly bar. When we go back to the 2000s and go here, it started the quarter on, where is it? 7-1. So here was the start of the quarter where we had that bigger move to the downside. And you can see the first quarterly bar, that first month, of the quarter, not much happened. The second month is where we started to pick up a little bit more. And then the third month of the quarter is where the biggest range lived for that move to the downside before it bounced back up. When we go back to the 70s, in 70s, the quarter started 7-1. So let's go back to 7-1. There we go. And you can see here in 74, I would argue the biggest range happened the second month, but this was pretty consistent on the selling that happened to the downside each month that occurred, right? So nothing is quite consistent as it is with that very nice quarterly signal, where every time it's that second quarter that has the biggest range to the downside. And then last but not least, in the 70s, the signal started on April, the fourth month. That was the start of the quarter. And you can see there the biggest ranges happened within the first 2 months of the quarter. And then the third month kind of just stayed within that overall range before we start to bounce back up from there. So I was kind of hoping, whenever I was doing this deeper dive into the monthly chart, that, every time on the second month of the quarter or something like that, right, that's where the biggest drawdown would happen. But it's just not consistent that way. And so what does that mean for if we want to put on a trade? Well, for myself, that personally means that I am leaning towards the June quarterly expiration, because that way it encompasses all 3 months. That way, if it doesn't happen within the first month, right, but the signal doesn't cancel out, I still have given myself some time for the remaining 2 months to still try and encompass that big drop overall. And for those of you who follow me on the $500 challenge, you guys know that I did already put in a trade idea to try and play to the downside. I did this right before Powell and the Fed spoke. That way, if Powell started to be the catalyst for some of this selling lower, then I already had a trade in. And if not, that's okay. It's easy to sit on it. And so for this trade, I set it out for the June quarterly expiration, right? Gave myself the full amount of time. And I went with the 3,500, 3,460, 34.30 put. So for those of you unfamiliar with this strategy, I'll pull this up on Tasty Trade just because I think it's easier to see the trade idea in that account. And I'll put this up on the option chain. But this is basically a debit style broken wing butterfly, where the debit spread portion of the butterfly is wider than the credit spread. And I jumped into this trade for $1.30. It's right at break even, right? So very small amount of capital risk. I only have $130 of risk out there in my $500 challenge account, which means that I still have $370 remaining and the account to still trade with. So if for whatever reason, let's say I'm wrong about the signal, let's all of a sudden say the market rips higher for whatever reason, and I can't even get a portion of my capital back and I lose the full 130, that's okay. I still have 370 left of the account to be able to trade with and ideally make that amount back and still end up profitable for the quarter. So very low risk overall. It's not blowing out my account if I end up losing on it. But let's look at that profit potential now. The profit potential based off a $1.30 cost basis, max profit potential is $38.70. So if going into the end of the quarter, we move lower. And then like you've seen for a lot of these quarterly bars, let me go back to the quarterly time frame here. But like you've seen for a lot of these quarterly bars, they don't oftentimes actually end at the low of the quarter. Even though they have the biggest range, they usually get a little bit of a bounce up after, that happens. So here, for example, in 2008, the low of the quarter was 741, but we closed the quarter at 903. Back here in the early 2000s, the low of the quarter was 944, but we closed the quarter at 1040. So a little bit less than 100-point bounce up from the lows. So my thought process on choosing these strikes were, one, let's say I'm off on my numbers, right? Let's say we do move lower, but it's even more conservative than my 32.15 first target to the downside. Let's say all we do is barely follow through with the lows of last year. That would satisfy the yearly bearish divergent bar and, make the signal still valid, but that's where we go to. Well, the low of last year is 34.91. So if all we did was go down to 34.91 and we start to stall, I am still in the money on this spread, right? So that's a nice thing to see. I would still be able to walk away with the profit. Let's say instead we do go down to 3,200. That's the low of the quarter. And then we bounce up some going into the end of the quarter. Well, if that happens, once again, a move down and then a bounce up could actually allow me to potentially hit the pin for the quarter, which allows for a really nice profit. But the benefit of doing a debit style broken wing butterflies, there's two really main benefits around this trade. The first one is, let's say it goes to that aggressive. Let's say we're down, 2,500 by the end of the quarter. Well, if this trade goes completely in the money, it still allows a profit for me. And that profit, for those of you unfamiliar with debit broken wing butterflies, the way you figure it out is you do the difference of the spread width. So on my debit spread side, I have 40 points of a width. On the credit spread portion of the butterfly, 30 points. So I do 40 minus 30, which is 10. So that means if I let this cash settle into the end of the quarter and we're trading at 2,500, let's say, then my trade would cash settle for $10. Of course, I need to take into consideration my cost basis of $1.30, which would still be an $8.70 profit. An $8.70 profit off of $1.30 of risk is still over a 600% return on the trade. Not a bad risk versus reward, right? So that's why I really like debit broken wing butterflies, because they have that forgiveness factor that if you have the direction right on the move, but let's say volatility really spikes and moves you past your strikes, meaning all of them go in the money, a debit style broken wing butterfly where the debit spread is wider than the credit spread still allows for a profit. The second benefit of doing a debit style broken wing butterfly is, let's say for whatever reason, I'm not anticipating this, but let's say all of a sudden at the very start of April, we start to crash, right? We get one of those huge 700-point drops, or all of a sudden, right? Let's just make the math simple. Let's say we go right to at the money of our long strike of 3,500. So we have basically a 470-point drop. And all of a sudden, even though we have still roughly 90 days left on the trade, we're all of a sudden at the money on it. Well, on a standard butterfly, even on the wider width ones, sometimes, it doesn't allow for as big of a profit as you would like to see. But on a debit broken wing butterfly, it can still allow for you to take that profit rather quickly because of the difference of spread width. So let's just price this out. If we do a 40, 30-point debit style spread and it's at the money, it's about 380. Now, obviously, I'd like a bigger profit than that. But let's say you had multiple contracts on this trade because you have a larger account than I do, and you see this move happen instantly going into the start of April. Well, you could already look to shave some of those off for a profit and walk away. Whereas if you did a standard butterfly, it's only about $1.20. Even if the move happens really quickly in your favor and it gets down to your strikes, the risk versus reward is not as nice as it is with the debit broken wing butterfly. And so that's the benefit of doing that style strategy on this, because it can really allow for some great risk versus rewards, and it can give you the forgiveness factor on one, if the move happens quickly and it's well before your expiration still, or two, if the move happens to go completely in the money of your spread itself. So that is, right, one of the trade ideas I'm already in. But let's talk about a few other trade ideas we could consider here. One of the trade ideas we could look to do, of course, with some of these targets, is to go out closer to 3,200, right? And do a wider vertical spread. For those of you with large accounts, you might even consider just getting into a long, right? If you have a larger account and that's within your risk tolerance for a normal trade idea to where it's not going to blow it out, you might consider just getting into a long put. But for those of you with smaller accounts like me, we can still look at ways to control our risk and leave ourselves with some very nice profit potentials. For example, here is the 3,300, 3,250, 50-point debit style spread. And right now, for the end of the quarter, that's about a 240 capital risk. So not too bad on the risk side. The profit potential is 4760. Excellent risk versus reward. So if we do move down to 3215 and test that level, and that's the low that we're looking for, then we know that the spread would be completely in the money and allow for a profit. You could also look at setting this up as a debit broken wing butterfly, very much like the trade I already have on. If we did a 50, 25-point spread, it's about $1.30 capital risk, right? Similar to the risk that I already have on that 3,500 butterfly. The max profit potential for this one is 4870. Excellent risk versus max profit potential reward. If it goes completely in the money, we once again take the difference of spread width, which is 25 points, right? 50 minus 25 is 25. We take away our cost basis of $1.30, still allows for a 2370 profit per contract if we see a bigger move than anticipated and it really dives in below our levels. So that's another way you could trade it. But keep in mind, SPX isn't the only vehicle you could look at. You could also look at the equivalent of SPY, right? The ETF of SPX. So let's just pull up SPY on the chart here. And for SPY, if you prefer, it has a quarterly expiration. The level that would correspond basically with the 3215 range is around 318, right, to 315. So you could go out here and jump into something like the 350, right? That's basically like the 3,500 butterfly. But you only pay 366. If we all of a sudden find ourselves down to, let's just round it up and say 320, then you're $30 in the money on this trade, right? Not a bad risk versus reward, very small capital risk. If this is still too much of a risk, I totally get it. I'm all about trying to conserve capital where I can. You could look at a vertical spread on the SPY. Here, the 350, 340 is a 10-point spread. It's 96 cents, right? Very small capital risk per contract. If the move follows through with the way that we're looking for to that conservative target, it allows for a 904 profit potential. Not a bad risk versus reward. You could even make it wider, right? Let's make it a 20-point spread. There, it's a $1.64 cost basis. If we go completely in the money down to that 320, 315 range, it's going to allow for a max profit of 1836. So once again, different ways that you could look to trade this. And of course, if you want it to be a little bit more aggressive on your targets, right? Because we do know that there's the possibility maybe this even goes down to 300, aka 3000, and test that range. So let's say we're anticipating that. Then you could go out here with just a long, right? Push it out further, but go with the 330, excuse me, SPY strike on the put side. It's about a $2 cost basis. If we get down to the 3200 range, aka around 320, 315, that would still be in the money for this strike. Let's say we go down to 300, aka the 3000 range. Well, then you're still 30 points in the money. Excellent risk versus reward. And then one more way you could look to trade this. We were actually talking about this today in the Profit Recycling Mastery, but you could look to trade it off of the VIX, right? Now, this is a little bit different, but the idea would be that you are anticipating more a spike of volatility to occur. And right now, the VIX is right by a price support level that we have seen within the last year of around $20. So let's pull up the VIX. If you think that by the end of the quarter, which keep in mind their expirations are a little bit different. So in this case, I would go with the June 21st expiration. It's just a little bit shy of the quarter, but still encompasses the majority of the quarter if it happens. We could go here and we could look to either just jump into a long call on the VIX, right? For example, the 25 is about a 276 cost basis. Or once again, you could do something like a vertical spread. I personally like the 25-35 levels. It's a $1.40 cost basis, 860 profit potential. And if we hit the kind of the higher range that we did of last year on these move lowers, then 35 is kind of the high end of that range on the VIX. So that makes a good place to keep the short strike on it and allow for a profit. If you want to be a little bit more attentive on your trade, you could also look at doing something along the lines of a calendar or diagonal. The issue I personally have with this on the VIX is when the VIX gets going, right, it's quick to spike. So you need to be very mindful of where your short strike placement is and understand that if it really starts to go in the money, that's not necessarily going to work in your favor. And being able to get a profit if your short strike goes too quickly into the money versus the long. But on a calendar trade, for example, you could go out a couple weeks, choose the 25 strike, right? That's how you create a calendar, reduce your cost basis, and then you can keep selling the short strike and rolling it out against your long strike each expiration, taking a small profit until you think that there's that possibility for that bigger move. And if you're anticipating that bigger move, then personally, I would just close the short strike and leave that long out there to play. But if it ends up being something where this move doesn't happen until like May, right? Let's say April's still pretty quiet, then doing something like this as a calendar or as a diagonal, right, can help you take advantage of the theta decay on the short strike when we're not seeing as big of a move, while still leaving a long call out there to play for that anticipation of a bigger spike in volatility. So those are some of the trade ideas I'd consider. I have a little bit of time to answer some questions, so let me try and go through the different chats and see if there's anything I can look at. iPod Touch, have I seen the study by LP Research regarding the close of SPX in the first quarter and the SPX low? No, I haven't. Did they have something similar? It found that since 1950, if SPX does not violate the December low from the prior year during quarter one, it has produced a positive return. So, see, that's a good example. So, you're basically saying, if we don't get past the low of December, let's go back to SPX here. Let's go back to the monthly chart because that's probably going to be the easiest way to look at this. But if we didn't violate the low during the first quarter period, then it's usually positive, and we didn't, right? The low of last quarter was 37.64, or excuse me, the low of December was 37.64, and then we got close to it in January, 37.94, but we didn't technically violate it. So unless we fall down in the next couple of days, right? Then that could be one of those clues where it doesn't work out. That's certainly a possibility, which is why, once again, I can do as much work as I can on the technicals, just like any other trader. But the only thing I can truly control is the capital risk I put out there. So I'm personally still going to look to put on some more of these bearish trade ideas. But like I said, the benefit about this signal, at least in my book, is the idea that we know the majority of the time when it follows through, we open pretty close to the high of the quarter at the start of the quarter, right? The quarter opens near the highs. So unless SPX really starts to rip up, right, that could be my clue that, oh, okay, maybe LP Research is right, and I need to start cutting back on some of my trades and protecting some of that capital. But thank you for pointing that out. I do appreciate it. And then let me catch up here. Yeah, of course, guys. Happy to give the analysis. And then absolutely, Jonathan, you could also do things like selling put spreads in the money and then using it to buy calls, right? Take advantage of the potential theta decay that can occur. Put credit spreads to help offset the cost of a long out of the money call or something. It's another way to be able to trade it. Absolutely. And then DC's asking, what is my stop loss? Usually on the majority of my trades, even outside of this analysis that I'm doing here, I usually am 100% okay losing the capital risk on it, which is why the majority of the times, if you've ever seen me alert out a trade, my capital risk in general is very small at the start of it. However, in this case specifically, I would argue if we really start to break back above. Now, once again, it's going to depend on where we actually close the quarter at. And I don't know what's going to happen within the next few days. But let's just pretend, for example, this is where we closed the quarter, right around 39.70. I would say if we start to break above this 10 period simple here on the quarterly chart, which is at 40.80, that's 100 points move higher, right? And that's definitely giving it some wiggle room. So if we really start to break to the upside by 100 points at the start of the quarter, that's where I'll probably look to shave off some of these trades. I might keep one or two in, like the $500 challenge trade, for example. I might stay in just in case it, does pop a little bit more before it sells off. But that's personally going to be one of my clues to say, okay, let me start cutting back on some, protecting some capital risk and cutting back on it. And ideally, right, not having to lose the full debit I paid. But that's why I tried to walk through trades with y'all to show you guys examples of ways that you can still potentially take advantage of these big moves on a very capital risk, right? So that way, if you do in fact lose the entire debit paid, it doesn't blow out your account, right? That it's still a very small risk. So another example of that would be, now I personally would like to keep it as a debit broken wing butterfly, but let's say you just want to do something like a standard, right? So you could do 3,300 and make it really wide, do 3,100. Excuse me, guys. And then go down here and do 2,900 and do like a standard butterfly that's 200 points in width on both sides. That's about a 370 cost basis. Your max profit potentials, $19,630 per contract. And then you give yourself a really wide net, as John says, to be able to catch that butterfly and lock in a profit. So it's all about really maintaining that risk and keeping it small and allowing for a very nice profit potential. And then Ari, unfortunately, so Ari's asking, I have a 3,800, 3,700, 3,600 put fly. How do you like that level for the end of April? Is it too high? Personally, the issue that I have with it is not necessarily the level. The issue I have is, unfortunately, we don't have a clear consistency on when the drop occurs, right? So, like, for example, in 2008 and 1970, the first 2 months were the biggest moves of the quarter. And then that third month was kind of like null and void, right? It just kind of hung out. But in 2001, for example, the biggest moves happened in the second and third month of the quarter. So if I had a little bit more consistency, like every time the signal prints for the quarterly chart, it's always the second month that gets the biggest drop, right? Then I'd be showing you guys closer expirations for the May end of month expiration, and we'd be pricing out things a little bit differently. But if April ends up being more a non-event like it was in 2001, right, then those strikes may not be high enough, arguably, or maybe they'll be in the perfect spot. So it's a little hard to say in my book for having that better probability, which is why all of the trades that I've walked with you guys are sometime in June, so that it's at the end of the quarter, so that way, no matter what, we know that it had a good probability of encompassing the move, whether it happens within the first month or whether it happens within the last month. And that's also why I tried to lean towards things like debit broken wing butterflies. So, for example, on this, you might choose to bring up the strike a little bit. Even if you did like this 200 butterfly, you might do 200 and then 175 for the credit spread. That way, one, if the move happens quickly, gives you a better probability of a bigger profit faster. And then two, if the move is much more dramatic and we break 2,900 by the end of the quarter, this would still allow for a profit if it goes completely in the money versus the standard butterfly. So I hope that makes sense, Ari. But that's kind of why, as much as I'd like to have things shorter dated, because obviously that would help control the capital risk, I'm just not as confident about what levels to play into necessarily. Because one, right now the market is extremely flat and choppy. And two, there's no consistency around which month it is that usually sees the bigger move. So I mentioned to y'all, if y'all joined me last year, that I would let y'all know if one, the signal on the quarterly chart printed, which it did. And then I told y'all if it did print that I'd come back at you with numbers and targets to potentially play to the downside. So like I said, my more conservative target, if this move follows through the same way it has in the past, is 32.15. Outside of that, I'm looking also more in line with technicals to play the move down. So 3,100 has moving averages on the larger timeframes to look out for. 3,000 is also a larger time frame to look out for. And then the most aggressive move would be down to 2198, which would actually put us right by those COVID lows if, it is a bigger move like what we saw in 2008 to the downside. Now, like I said, I'm not anticipating that one. I'm aiming more for the conservative targets. But obviously, if we start to break those levels, it's good to know where some of these other numbers are at so that we can look to play them throughout the quarter if that bigger move is what ends up following through. So thank you guys so much for joining me in this aftermarket webinar. For those of you in the simpler rooms, I will get these posted to the room drive, so they should be in there no later than tomorrow. But I hope you guys have a wonderful rest of your evening. As always, may the trade be with you, my fellow Jedis. Please continue to be mindful of your capital risk, right? You don't need to necessarily load the boat to still be able to potentially take advantage of this move. And of course, if we really start to bounce up next quarter, we might already look to protect capital on some of these and take it off. So have a wonderful rest of your day, guys. And I look forward to talking to y'all next time. Bye.